Looking at a very high-energy investment analysis report today, one titled, Serv Stock Explodes, plus 10%, next stop $21.
Yeah, that title really grabs you. It's timely, for sure.
It focuses on Serv Robotics, obviously, after a big surge. The whole case seems built on a short squeeze and some, political speculation.
It is. And look, the analysis itself has a really strong foundation. It nails the three critical drivers. You've got the policy angle, the short interest, and the fundamental growth.
Okay. But to get this from being a great piece of market commentary to a truly robust investment case, we need to sort of readjust the weight of those drivers. Let's jump into the first big opportunity right now.
All right, so a huge part of this analysis seems to be the technical setup.
It is. It points to that short interest, 19 to 22% of the float, and then volume spiking 2-3 times the normal level?
Right, and the argument is pretty clear. This forces shorts to cover, you get a buying frenzy and the stock goes vertical.
Exactly. But is that the whole story?
Well, that's just it. That buying frenzy narrative is compelling. But here's the issue. The analysis relies too heavily on short-term market dynamics and should elevate the fundamental growth narrative to fully justify the long-term price target.
So it's a structural problem then?
I think so. The short squeeze, it's a valid accelerator, no doubt about it. But when you frame it as the primary driver,
it makes the whole thing feel like a temporary trade.
Precisely. It feels like it's all based on market psychology, not a long-term investment in a business. And what it does is it overshadows the really impressive stuff in the report, like that 200% year-over-year revenue growth from Q3.
That number kind of gets lost in the noise.
It does. All the exciting language about a powder keg distracts from the real long-term value. So the suggestion is pretty simple, really.
Okay.
Reorient the report. Lead with the fundamental growth story. Talk about the strategic importance of autonomous delivery first. Then you can position the political stuff in the squeeze as, accelerants to an already sound trajectory, not the core reason for the move.
I see. But couldn't you argue the squeeze is the hook? I mean, that's what got everyone's attention in the first place. If you lead with fundamentals, do you lose that timeliness?
That's a fair point. But you don't lose the hook, you just integrate it better. You first establish why the market should care at all, that's the 200% growth, and then you explain why the market structure makes the reaction so explosive.
Ah, okay.
And to make that shift concrete, the analysis needs to spend more time on the quality of that 200% growth.
What does that look like in practice? The quality analysis, I mean.
Well, for example, the material mentions their niche is last-mile delivery, right? And that it solves a massive labor shortage issue.
Right.
That's the real thesis. That's the structural reason revenue is doubling. You need to expand on that. How specifically does Serv Robotics solve that pain point? Are their robots actually cheaper than paying someone minimum wage plus benefits? Are they more reliable?
Those are the questions that justify a real valuation.
Exactly. A $21 valuation, regardless of who is scrambling to cover a short position. You focus less on that the stock is moving and more on why the business is growing.
Show the economic argument for the product itself.
You got it. And that's where you can use that high analyst target, the 27 one. Frame that as the long-term potential and use the 200% growth as the primary justification for getting there. This is also where you change the language.
Less hype.
Way less hype. Shift from words like powder keg to discussing things like, say, the operational leverage that's created by scale and market penetration.
Operational leverage. That's a really key concept for a company like this, isn't it?
It's everything. It means once they cover their fixed costs, R&D, infrastructure, every new robot they put out there generates more and more pure profit. It's how they get out of the cash burn phase.
And showing how that 200% growth gets them there faster.
Proves you believe in the business model, not just the market chaos. That shift alone elevates the entire analysis. It makes it feel so much more substantive.
Okay, that makes perfect sense. Let's move to the second major theme then. This one deals with that macro catalyst. This one feels high impact, but also pretty high risk.
It is, which is why the analysis must more robustly address the uncertainty inherent in the key political catalyst, providing clear scenario planning for non-confirmation.
So the bullish catalyst here is this Trump trade idea. The report mentions a potential executive order designating robotics as a strategically important industry.
Yeah, and the implication is that could lead to subsidies or deregulation, things that would pour fuel on the fire.
A huge engine for the thesis.
A massive engine, but look at how it's introduced. The language is, reports are leaking, potential policy shift. It's all hedging.
And that's the weakness.
That's the weakness. It introduces this huge catalyst, but then there's no follow-up. There's no structured analysis of what happens if the policy is delayed or if it just doesn't happen at all.
It leaves the entire thesis vulnerable.
Extremely vulnerable to political winds and rumors. The valuation is basically tied to speculation at that point. The analysis needs a defensive strategy.
So the investment case has to stand on its own 2 feet.
Precisely. The suggestion is to build in an explicit contingency analysis. Some clear if-then scenarios. The report has to prove that the path to $21 is still viable based on the fundamentals, even without that policy tailwind.
Detach the valuation from the political ceiling.
You have to, and that gives the reader so much more confidence. But there's a detail missing here too.
Oh?
What are the actual benefits of being a strategically important industry? The report doesn't really say. Does it mean tax credits, faster permits, government contracts?
You need to define the stakes to understand the risk.
Exactly. You need to articulate those potential benefits so we understand the magnitude of what we're modeling against.
So how would you actually build that model in the report?
I think you need 2 distinct pathways to get to that $21 target. First, you have the policy-confirmed path. That's your fast track. That justifies the rapid move past that $15 resistance level.
Okay, the bull case.
Right. But the second one is more important, the policy delayed failed scenario. And that path has to rely entirely on the company's execution, on sustained Q3 growth rates, on analyst sentiment that's based on performance, not politics.
So you're showing that the fundamental engine is strong enough on its own, even if the policy rocket, never takes off.
You got it. And for that policy delayed scenario, the report should be specific. What's the hurdle? Do they need to maintain 200% growth for 2 more quarters? Do they need to hit 5,000 deployed robots? Give a real metric that would be required to hold that $13 floor and keep appreciating slowly.
That's very tactical advice.
It has to be. And one more thing on this. Instead of just saying smart money is front-running this policy change, the analysis should suggest how an investor can actually manage that risk.
Like what?
Like defining a hard exit. Maybe if the stock can't hold $13 for 2 weeks, you get out, regardless of what the political pundits are saying. It adds a layer of defensive strategy. It turns the analysis from just reporting into active risk management.
That shift is incredibly valuable. Okay, let's go to the final area of improvement, which ties back to that high-energy tone we talked about at the start.
Right, this is about analytical integrity, really, and structure. The high-energy breaking news style of the report minimizes the assessment of risks by relegating crucial caveats to a single brief concluding section.
I definitely noticed that. You get this huge bullish case policy, the squeeze, targets up to $27, and then all the warnings are just bundled at the very end.
Almost like an afterthought.
Yeah, still burning cash, volatile stock, small cap.
And that's the weakness. When you consolidate all the risks into what is basically a disclaimer after promising massive upside, you're sacrificing objectivity for excitement.
It dilutes the gravity of those risks.
It really does, especially the still burning cash part. A reader gets caught up in the promise of a 60% gain, and they might just gloss right over that critical detail.
The hype gets prioritized over the hard numbers.
So the suggestion is to integrate the risks right after the corresponding bullish point. It demonstrates intellectual honesty. It strengthens the report's credibility because it shows you've already thought through the downsides.
It feels less like a sales pitch and more like a balanced analysis.
Exactly. Let's make it actionable. Take the cash burn example. Right when the report is talking about that 200% revenue growth.
The huge positive.
That's the moment you should immediately introduce the still burning cash caveat.
But not just as a warning, right?
No, never just as a warning. You analyze it. You ask, what's the rate of cash burn relative to that growth? What's their current runway? Can they go for 18 months at this rate, or is it more like 6 months before they have to raise capital again?
You turn the caveat into a quantifiable metric.
Yes. You transform a liability into a performance risk that can actually be tracked. That's a much more sophisticated way to handle it.
It turns the risk into an operational metric the investor can watch. I like that.
And you do the same thing with volatility. When you're discussing the technical path to $21, breaking that $15 resistance.
Right.
That's when you immediately frame the volatility. You talk about historical drop-offs, the need for tight stop losses. You don't save that crucial advice for the end. With a stock like this, the floor can drop out fast. Risk management has to be front and center.
And finally, that ties into the language itself, the sensationalism. If you integrate the risks, the tone has to change too.
It has to. You have to tone down the sensationalism. Look, high hype language like powder keg and scared shorts, it's fine for some market commentary. But it actively works against your credibility when you're also providing serious analysis about a 1950 average price target.
The style and the substance are fighting each other.
They are. The language should match the quality of the financial analysis. You want to make your bullish case stronger through measured confidence, not just raw excitement. Confidence that's supported by data is always more persuasive than hype.
This has been a very focused critique.